Have you ever looked at an investment opportunity and wondered, where do I begin? There are purchase prices to compare, interest rates to calculate, cap rates to analyze, repair estimates to verify, rent projections to research, neighborhood trends to evaluate, and exit strategies to consider. Every property arrives wrapped in an overwhelming amount of information, and most investors assume the secret to making their decisions is simply learning more. I don't believe that. Over the years, I've watched intelligent, hardworking investors consume an incredible amount of information while still making expensive decisions and mistakes. Why? Because they gave equal attention to every piece of information instead of first deciding what deserved their attention. I've come to understand that every real estate deal needs discernment. The best investors I've met aren't the ones who know the most. They're the ones who have learned to filter the noise. They know which questions to ask first, and those questions simplify every decision that follows. That's why I created the four numbers. Not because they're the only four numbers in real estate. There are actually dozens of numbers that matter depending on the investment, the strategy, and the market. But after evaluating thousands of investment opportunities, I've discovered there are four realities that must be understood before analyzing anything else. Think about it. Think about the dashboard in your car. Thousands of components are working together every time you drive, yet you don't monitor every wire, bolt, and sensor. You glance at a handful of gauges because those gauges quickly tell you whether everything else is healthy. The four numbers serve the same purpose. They aren't every number. They're the numbers that tell you whether it's worth looking at the rest. Holding costs. This is the number most investors fail to consider. Before ever thinking about making money, it's essential to understand what it will cost to own the property. Holding costs are every dollar required to own the property before it produces a dollar for you. Now, we're going to unpack the components of this in another lesson. But for now, every investment creates financial pressure before it ever creates financial opportunity. If holding costs aren't calculated correctly during a renovation or even while a property is tenant occupied, then the remainder of your property analysis becomes completely unreliable. Operational cash flow. Once the property costs are understood, it's essential to ask, how much revenue will the property produce after all holding costs are calculated in? And ask, will this cash create enough financial margin to support your dream, or does it quietly consume it? Positive cash flow gives you options. Negative cash flow slowly takes them away. Coverage. Many investors know this as DSCR, or debt service coverage ratio. At its core, coverage asks a very simple question. Can the rent cover the mortgage? That's all DSCR is. You simply divide the monthly rent by the total monthly mortgage payment. This includes principal, interest, taxes, insurance, and your HOA or condo fees. But I want you to think about this differently. I want you to think of this as independence. If something unexpected happens, will the property continue supporting itself, or will it start sucking you dry financially? Healthy investments become increasingly independent. Weak investments become increasingly dependent on you. When the rent consistently covers the mortgage with margin, that's the key, with margin, the investment property will continue to produce positive revenue. And over time, that's one of the reasons real estate has the potential to outperform many other investments. Not because it's magical, but because the property is doing more of the heavy lifting instead of relying on you. Total Wealth ROI. This is where many investors stop thinking too soon. Monthly cash flow matters, but it isn't the whole story. Real wealth is created through the combination of cash flow, principal reduction, appreciation, tax advantages, and leverage. It's essential to understand how these pieces work together to increase your long-term wealth, not just your monthly income. So when you step back, you'll notice these four numbers answer four fundamental questions. Can I afford to own it? Will it create financial margin? Can it stand on its own? Will it actually build wealth? These questions have guided nearly every investment decision I've made, and they've helped me avoid opportunities that looked exciting on the surface, but couldn't support the life I was trying to build. That's really the purpose of the four numbers. They aren't another complicated spreadsheet. They aren't another formula designed to impress people. They're simply a framework for seeing clearly before you commit capital. Why? Because confidence doesn't come from knowing more. It comes from knowing what matters most. If you'd like to learn how to calculate each of the four numbers and see how they work together when evaluating a real estate investment opportunity, I've put together additional resources to help you go deeper. Because at the end of the day, the dream determines the deal. The numbers protect the dream.